Okay, we are joined now by Bart Melek. Great to talk to you again, Bart. It feels like it's been a long time. He's Global Head of Commodity Strategy at TD Securities. Give us your thoughts on oil. What's the most important thing in that market right now?
Well, I would still say the supply side and the constraints on the supply side, OPEC not really being able to deliver on its promised increases. There's a bit of inability to deliver, and there's a bit of perhaps unwillingness. And at the same time, we're seeing pretty significant constraints on the refining side, which is really rallying products quite significantly over and above where you would expect it based on where the oil price is. And that means there are a lot of factors on the supply side, including the product side, that are driving things up. And let's not forget, there continues to be a geopolitical risk premium added to this whole complex.
I sort of chuckled there, Bart, because there's nothing funny about the current oil or food crunch, but OPEC Plus OPEC has just been so stubborn, hasn't it? Even if they could raise production, and you've indicated that they are having problems, but they have not offered to lend a hand at all, have they?
Not really. Last case in point, they were short 2.7 million barrels last month. And there aren't a lot of signals coming from OPEC Plus that they will do any more for the foreseeable future. And that implies that this market is going to continue to be quite tight. Their concern, of course, is that the lockdown in China and a potential slowdown in the global economy as rates rise significantly may very well bring this market to a bigger balance than we expect. So they are being very cautious. They're looking at supply-demand conditions going forward, and they're not particularly convinced that these markets are going to be overly tight.
Yeah, because you think that crude prices, the signs are anyway, they're going to remain firmly above $100 for quite a while?
Well, certainly, this is what we wrote last week. I basically thought that as the driving season matures and peaks, nice weather gets people traveling for holidays. When you look at the consumer spending indicators in the United States, tourism is now, really recovering to a significant way. You add on to that lack of global refining capacity, and we have a recipe for significantly higher product prices. And that will eventually cascade down towards the feed as well. If you're getting large premiums on the product, you're able to pay more on the margin for the feedstock as well.
Talk to us about gold. You think the time for gold is not now. That's your suspicion anyway.
Well, so far I've been proven incorrect because gold has done fairly well. To our defense for second quarter, we are pretty much right on the money in terms of where the averages have been in our forecast. But what do we see? I think in spite of the fact that we've seen some moderation in the PC inflation last week, I think it's much, much too early to say that the Federal Reserve won't have to get aggressive on the tightening side of monetary policy to control inflation. I still think inflation is going to be stubbornly high. Food comes to mind, fuel comes to mind. Of course, fertilizers are sky high, and we're seeing the consumer move more into services, which will eventually start pricing in higher fuel costs and everything else. So this will take much longer than I think many have expected, and I suspect the Federal Reserve is going to have to get quite aggressive for this foreseeable future. So the idea that we're not going to get significantly higher rates, I think, is a bit misplaced. And when we come to realize that, probably a little bit after during the summer, as time goes in, some of those gains in gold will be unwound. We still don't think there is going to be a major rout in gold prices, but I think a move towards just below 1,800 is very, very possible as we move into the end of 2022.
Maybe we could put up a 5-year chart for gold. It must be a disappointment, though, to the gold bugs. The inflation goes to the highest in decades, and gold doesn't do that much.
I think there are those who are disappointed, but we should look at gold's performance relative to other classes, and I think for the most part, it has done fairly well. So its hedge credentials continue to be there, certainly outperformed bonds, many equities as well. And yes, in absolute terms, it hasn't surged after moving to 2070 earlier in the year. It fell off. But gold is not really a function of inflation. It is, but it's really how central banks and monetary authorities react to inflation. If you go back to the 1980s when Mr. Volcker started his tenure as chair, inflation was sky high, and then we saw a collapse in gold soon after. And that was not because inflation wasn't high. Inflation was high, but monetary policy got very, very restrictive. So I'm not at all surprised that gold has drifted lower somewhat. And that's because we expect monetary policy to tighten up and real interest rates to start moving higher. In fact, that's exactly what we've seen on the 10-year end of the yield curve in real terms. We've had quite an aggressive increase in real rates, and we're going to see an aggressive increase in real rates as well as the front end of the curve moves up with the Fed funds, and most likely inflation starts migrating lower. Let it be clear, still very high levels, 3-decade highs or so, but we'll probably have seen the highs. It will take a while for it to fall, but as rates move up, you're going to see those real rates move higher as well. And that tends to be the biggest driver of gold, is those real interest rates, particularly, I think, between 2s and 10s.